Good afternoon, everyone. Thank you for joining us on this very nice spring afternoon. My name is Jen Hicks. I'm the Director of Outreach and Events, and I am very pleased to have this group here to talk to our very good friend Jim Norris, who has been a board member with Maine Woodland Owners in the past, has been involved in our committees, and is a very big dedicated supporter of ours. He's also a retired IRS forester, and so he has had many years of experience working with the forest industry and those who are managing forests and helping understand the complicated world of timber tax. So Jim is here to present some key information about what it means to include your timber activity in your taxes. If this is a year that you have had, or last year was the year you had some timber activity and some sales and revenue, then you will be very glad to hear from Jim tonight, talk about some of the details you may want to consider as you're filing your taxes. We're definitely getting to the point where it's time for that. And so Jim's got a very useful, very informative slideshow that he's going to be using, but I know for a fact that he will be very happy to answer questions as he does his presentation. So you can ask your questions in a couple of different ways. As I had mentioned, the chat feature is a great place to type in your question. That will get my attention, and I would probably stop Jim and let the person who sent the question to ask the question verbally. Mute yourself and go. You can ask Jim. Another would be, I'll just read the question and he'll answer. And then the other is, if you we'll take a couple breaks. This is a 2-hour program, so we'll stop, check in, see if anybody's got questions. You can jump in with your question by unmuting as well. If you want to get my attention, don't want to use chat, go ahead and turn on your video, and I will be watching for people, and you can actually raise your hand and let me know that you would like my attention, like to ask a question or get some clarification. So that's all I've got. Again, thank you very much for being here. Maine Woodland Owners is been around since 1975, providing the support that woodland owners seek to manage healthy forests here in Maine. So this is one of the many ways we like to support our woodland owners through these programs, these online programs. We have a few other events going on this month, and we have April events already scheduled for online programming. So please check our website when you get a chance at mainwoodlandowners.org/events. And without any further ado, I'm going to pass the mic over, or I guess whatever you would call this, over to Jim, and he will take you through his timber tax presentation. Jim, thank you very much for doing this for us.
Will do. Well, welcome, folks. There are a few familiar names in the audience, Claustrons, but as Jen said, I worked for the IRS for over 30 years, generally speaking, in a forester, appraiser, natural resource appraiser capacity. Generally involved in the examination of large forest products companies, dealing with a host of different issues, everything from depletion to road costs to proper basis, allocation of basis. And most of my work with small landowners was advisory during about this time of year. It was a useful part of the job, and it probably was the best part, to be honest with you. So I'm getting to do what I enjoyed most about my job. I am located in the Augusta area. I now do consulting work, assisting in allocating cost basis and helping to report timber sales, both in terms of some simple advice that can save time to multiple hour work, trying to establish the proper cost basis for eventual reporting of timber sales. So we'll move along now. I think it's important to point out to you that much of the text material was taken, you can see my side picture as well, from a book called The Forest Landowner's Guide to the Federal Income Tax. It's Ag Handbook number 731. It's a great government publication. I had the good fortune of being able to assist in drafting and proofing over the years. The U.S. Forest Service was responsible. You can get this electronically on a website called timbertax.org, along with a number of other useful articles and publications that are available, again, through that website. One important area we need to distinguish here is, what are the types of forest land ownership and how are they going to impact how you're reporting timber sales or how you're treating your activity. It's important to know the purpose of holding the timber, whether it's a personal use, as an investment, and I'll get into the exact definition, but most of us are holding timberland as an investment. Otherwise, we're not deriving regular annual income from it, but we are hopeful that at some point in time, a timber harvest is going to generate income, and it will be treated in the form of a capital gain. And lastly, whether or not it's a business. Small landowners have a difficult time, generally speaking, to qualify as a business and have the benefits, but sometimes the drawbacks of being a business, the benefits of claiming certain types of expenses and exactly how you treat your income. And of course, whether or not you're an incorporated business or a partnership or a trust. Personal use is simply, it's not used for producing any sort of income. It's, a small, maybe some half acre of woods on your 2 acre woodlot. And so even though you expect to sell it, you really weren't intending to sell timber as a part of your so-called investment. Most of us, I've cut my woodlot in 35 years, 3 times, different levels of timber harvesting. I refinanced my mortgage. I took my family to Disney World, and I was able to replace my windows with replacement windows. So it's turned out to be a good investment. I'm not sure I cut firewood off it on a regular basis, but so, it's an investment to me. It happens to be part of my, I have a 30-acre home site effectively with, and then of course with a business, you've got to be carrying on the activity on your property primarily for a profit. And your activity's got to be more regular than it might be for an investment. If in fact you're treating it, attempt to treat it as a business. There have been a number of, I used to have a lot of contact with IRS agents doing office audits and small corporations as well as major corporate. And every once in a while, someone would come to me and say, this guy's got a four-wheel drive pickup and a chainsaw, and he's telling me he's in the business of his woodlot. And what he really was trying to do was to get a substantial upfront depreciation deduction. Generally didn't work too well. Cost considerations are a real big deal, as we will explore further. Cost considerations, especially so that you can determine what your cost basis is in assets that you either inherited, were gifted, or were purchased. Some of your costs are capital costs. When you, it's capital in nature. You're creating a permanent asset. Additionally, you might have, if you're a business, you might have a deductible business expense. A cost of sale, we'll get into that in a little more detail, but it's a cost that was essential in making a timber sale, and it can be used as an offset to the gross proceeds to get your net sale proceeds. I just mentioned we talked about your original cost basis and your adjusted basis, which can change over time if you sell property, if you sell timber, or you acquire additional assets. I did mention purchased, inherited, and gift. And of course, the allocation of your original cost basis. Capital costs generally cannot be, if you're attempting to be considered a business, capital costs can't be deducted against income, again, because they're a capital cost. Costs that can be deducted against income if you're claiming to be a business don't have a duration or a benefit of more than the current year. A capital asset has not necessarily an indefinite life, but certainly provides you a benefit beyond the existing year. It can be, as I said, used up, worn out, and generally the recovery of those capital costs are recovered when you sell the property. Capitalizing those costs is in fact called capitalization. Any accountants in the crowd, tax preparers, bear with me. I'm a forester, not an accountant, despite having spent a lot of time with this. And anyway, capital costs, money you spent to acquire real property, equipment, improvements that increase the value of existing capital assets. Examples of those can be the land, the timber, buildings, machinery, and equipment that last more than a year. Generally speaking, those of us who are in this forest land ownership as an investor generally are dealing with the first two here, land and timber. Typical woodlot may have just those two assets. Of course, the land could include open fields, home area, but from a depletion standpoint that we're going to get talking about, we're basically talking about land and timber. if in fact one is in this as a business, you may be able to depreciate bridges that are necessary. You may be able to depreciate portions of logging roads or roads to access the timber. I'm going to get into some additional information about road cost treatments because some of the roads are necessary to make the timber sale. Therefore, they're deductible against the timber sale. Things like culverts and fire breaks and some site preparation if you're doing certain types of reforestation, i.e. tree planting and seeding. But most of these don't apply to the standard typical forest landowner, small forest landowner who has a woodlot. In regards, as I said earlier, I get ahead of myself, bear with me, but purchase of timber it's a capital expenditure. You may incur certain costs, planting a seeding associated with it, not so much here in Maine, but the original basis of capital assets is the total cost of acquiring it. And that can include legal fees, brokerage fees, and perhaps some surveying costs and so forth. And costs that are not directly related to the timber on the property have to be prorated based on the relative value of the components, i.e. the land and the timber. It's obviously to our advantage to maximize our costs in timber, as you will see. Inherited assets, a woodlot, is the basis of it is in fact its fair market value. So some sort of appraisal or indication as to what its value is if in fact it's inherited. Cost basis is, the term is stepped up anytime that an asset is inherited. It's as of the date of the decedent's death. There are some other federal estate tax implications, i.e. a choice of an alternative valuation date, which is usually 6 months from the date of death. And I assume it's there to give people an opportunity to complete the settlement of the estate and so forth. Assets received by a gift is based on the donor's adjusted basis. One of the dilemmas that woodlot owners face, along with others, is, how do they intend to plan their estate, trying to, most of us aren't going to be subject to federal estate taxes. The minimum now for being considered for federal estate taxes is incredibly high. But whether or not you want to give your woodlot to your heirs or someone else, or will they inherit it? If you give it to them, your cost basis becomes their cost basis. And if you acquired it a long time ago, chances are the cost basis is going to be relatively low compared to its fair market value. So in allocating the original basis, it has to be your cost. It has to be allocated to the assets in proportion to their fair market value. This is generally no easy task. For the most part, it's one of the two reasons people secure my service now, including some of the accountants, because as you know, lots of times people have no idea what the value of the bare land is versus the timber. And many times people are willing to pay based on what's important to them. So things like location, things like accessibility, things like developability, and even things like how much timber is on the property come into play. Although most purchasers do not know what the fair market value of the timber on the property they're purchasing actually is. And lots of times it's, what the total purchase price is what the market will bear, what previous sales have shown is realistic. It's important over the long run to set up the timber accounts. And I'm going to be showing you how at least the IRS encourages people to set up accounts. Some people can do them in great detail, but the IRS has an information report. It's not a tax return, known as a Form T, that provides a means of separating your original costs into land, timber, and perhaps some other land improvement assets. A land is just what it says it is. It's the land itself, and land is considered a non-depreciable improvement, except in certain cases. And if you're a business and you were to put a hot top parking lot in, you might incur costs that were included in building that that are going to be subject to wear and tear from the weather and use and so forth. But generally speaking, land costs are non-depreciable. For instance, if you're incurring costs of building a road, other than a road for just getting the timber out, like a skid road or a small road, the costs incurred in clearing the land, grubbing, rough cutting, and filling are generally non-depreciable. The land is not going to change over time. And that's contrasted with the gravel surface, the surface of the road. Again, if you're not claiming to be a business, that is not an opportunity for you to depreciate it. It may be that gravel work and periodic improvements are necessary for current or future harvests, and they can be treated as a cost of making the harvest. The timber account, obviously, this is real focus of why we're here today. Merchantable timber. That's what we're allowed to deplete, otherwise recover our costs in merchantable timber as we sell it. Here in Maine, we generally don't, most people don't generally separate merchantable timber from what they paid for young growth, trees that are not merchantable. Down south with, reforestation being a real big deal, that is a distinguishable asset and, needs to be treated separately and recovered as it becomes a merchantable timber, whether it's 20 or 50 years later. That's when I'm talking about plantations, especially down south. The timber account is, again, for merchantable timber. You might describe it as, in a variety of ways. Historically, cords were a, 4x4x8 wood, or saw logs in thousands of board feet, generally called MBF. And more common now, we seem to be dealing with treating our volumes in tons and with corresponding prices. In part because a lot of the wood we're selling now, timber we're selling, is eventually measured in tons when it's delivered to mills or otherwise. It requires a conversion between all of these. There are 2 cords for 1,000 board feet. There are generally, say, 2.5 tons per cord, 4.8 to 5 tons per 1,000 board feet. And when you make that conversion, you make a corresponding conversion in prices. So I'm going to talk very briefly about operating expenses and carrying charges because, again, these generally apply to those that are going to be filing a Schedule C business report, and not to those of us who are in the investor category. So a lot of the same rules that apply to any business would apply to people associated with management of their forest property as a business. Now, it's a whole lot easier to meet the necessary requirements for filing as a business the larger the property is, and the more actively you're involved in its management, or the greater need for incurring costs for assistance and the regular timber harvesting. These are the kinds of costs that you might incur in that case, hiring a forester, traveling to the property to perform different types of activity, hiring people, generally. So an important word here is maintenance. Things that are costs that you don't receive a particularly any real noticeable benefit beyond the current year or beyond the immediate future. Operating expenses, is it ordinary and necessary for that business? And with forest land, that's a whole lot different than what IRS people see for a mom and pop store or other types of small businesses. So carrying charges pose a little different circumstance. You may, even as a business, you may elect, you have a choice of certain carrying charges to expense or capitalize them, but carrying charges can only be capitalized. We're talking about taxes, interest, other types of expenses that are really related to the development and operation of the property. Taxes, what we tend to see, if in fact your woodlot is, as mine is, part of my rather large home site. So I can no longer itemize deductions. I guess that's a good thing. But if you itemize your deductions and you claim as a deduction on Schedule A your property taxes, obviously you can't double dip and then capitalize them. And so let me see here. In the case of unimproved property like we have, it's, as I said earlier, taxpayers can elect on a year-to-year basis to capitalize annual taxes, mortgage interest, and other carrying charges. And those have to relate to the forest land portion of the property, for sure. And those are generally defined as land without buildings, structures, or other improvements. Income, obviously, from forest land, not so much here as, hunting leases but timber sales and sales of cut products are not routine, regular sources of income. And so,
Jim, is this a good time to take a quick check-in to see if anybody's got questions?
Anytime, stop me.
Okay, I haven't gotten anything in the chat, but I figured this might be a good time to just check in. If you have any questions, go ahead and unmute and just jump in and go ahead and ask your question. I'll give you a couple seconds here.
Am I muted or unmuted?
I hear you.
Oh,
Go right ahead.
okay. This is my name's Ian Smith, and in my family we have a situation where there's a transition between generations of woodland, and my question is about the value carried forward. So if, for example, the land is inherited, does that mean that any and all timber sold from that land, is that the new carried forward price, or are there capital gains on timbers sold on inherited land?
Okay, as I said earlier, your cost basis in particular, let's just say you inherited this property this year in 2020. The cost basis in the timber or all the assets to you is in fact the fair market value, which is current values, not values that applied to the original purchase or the original inheritance. So and that's a good thing, generally speaking, especially if you're going to be selling timber. Otherwise, the higher your cost basis compared to the actual sales price of the timber or any of the other assets, the smaller the gain or the potentially taxable gain. Of course, if you own, I'm going to get into selling timber here very shortly, but you know, the sale of timber, if you're not a corporate interest, the sale of timber that you hold for at least 1 year is subject to capital gain rates, just like the sale of other capital assets, stocks, and so forth. And those tax rates are extremely low, if not zero. So I don't know if that answers your question, but effectively your cost basis is stepped up to current values.
I think that answers that question entirely.
Okay. All right.
Anybody else want to jump in with a question?
These costs that I have on the screen now, these carrying charges, generally relate to, you know, developing the forest land, not in a commercial or residential sense, but establishing the stands, establishing the road network, and so forth. Forest management expenses, if you're an active business, they're fully deductible. Passive business is a business that you own, but you don't actively participate in. Forest management expenses for us, generally speaking, us, held as an investment, are subject to a floor at 2% of the adjusted gross income. So but you still need to be be in the position to file a Schedule A itemized deductions. If you're a business, these kinds of expenses can be fully deducted. And if in fact you have the ability to actually claim some of these expenses, what you're not eligible to deduct, you can in fact capitalize those costs and recover them when you sell timber. Okay, income considerations. We're talking about timber sale receipts. We're talking about determining what kind of a gain or loss and the amount of that. What are your costs of making the sale? We'll talk about what those are, but those are costs that directly relate to the sale. How does this impact your basis and your current adjusted basis? How you actually recover that basis? Generally speaking, we're talking today about recovering your cost basis because you're disposing of standing timber. Even though you might hire somebody, some company, to handle the sale of timber on your property to a mill, there is a component of that sale, i.e. the sale of this hypothetical sale of the standing timber, that is allowed capital gains treatment. And so we're interested in recovering whatever we have for basis in the cutting or sale of the standing timber. The type of gain or loss really depends on how long you've owned it, why have you owned it, how did you sell it, and what kind of timber-related activities did you engage in? I said earlier that you need to own the timber for at least 1 year to get capital gains treatment. And so the cost of sale we're talking about, if you're selling timber, probably a good time to mention this. Some of my examples are going to show it, but you can dispose of timber in a variety of ways now. Historically, we had what was known as stumpage sales, where you sold timber, standing trees to a logger, or you had a forester or someone assist you in finding a logger, setting up a contract, overseeing a sale in return for some sort of commission. Subsequent, in recent times, some forestry companies are actually buying the timber from you, and they are then the owner of the timber when they have it cut and when they have it delivered to a mill, and your income would be just simply what you receive for selling the standing tree. And I'll have an example today where several companies are now involved in really providing a service to you in selling timber, selling log products to a mill. So what they end up doing is making sure that the wood gets cut, making sure that the wood is transported to a mill, finding markets, and then they will deduct, in order to get what they're going to pay you, they will take the mill delivered price minus the hauling price, minus the cutting price, minus their commission, and the net result is an approximation of what the tree is worth on the stump, and would likely represent something similar to just selling the standing timber. You can see these kinds of costs that are associated in direct costs of making timber sales. We don't see it a lot directly to us as landowners. We see generally the marking and scaling and the consulting forester or someone who's assisting. And those are deductible against the sale. We're going to get into that in detail. I'm going to mention something that I'm not going to take a lot of time with. I'm in the process of preparing another presentation with NRCS and Natural Resource Conservation Service, federal service. There are there are payments made, cost share payments made by the federal government that relate to costs related to conservation of so-called conservation assets. And some of those costs and to certain individuals may be excludable from income. But just because they're excludable from income, they're not, you can't double dip and then try to somehow capitalize them or deduct them. Excuse me. Questions arise as to whether you include cost share payments in your gross income. Generally speaking, anything from NRCS and some of the other qualifying payments, you would receive a 1099 G, as in government. That's indicated, that's so the IRS knows you received some potentially taxable income from this. Some of you might recognize these EQIP programs, Wetlands Reserve, WIP, Wildlife Habitat, there's OCRP programs generally out west. So these are the kinds of things that fall in that category. They're dealing with this is really in a position, in a location in the code of section 126. I'm going to read this and then kind of move on. Taxpayers who receive cost share payments from federal or state generally must report the payment as part of their gross income. Under the provisions of 126, however, forest landowners and other landowners can choose to exclude from their gross income all or part of the cost share payments that meet, as I said, their conservation of soil and water, their capital and nature. And there's a process by which you determine the exact amount. That process is outdated, it's confusing and difficult. And I find many folks just simply exclude it from income and deal with the consequences, or add it to income, and because it's a nuisance. There are information returns. This is a real key part of this presentation today. If you purchase standing timber, otherwise as a logger, or as some other type of contractor, if the purchaser is going to claim it as an expense, they need to file a form 1099-S, as in Sam. That's proceeds from a real estate transaction. Or a 1099 miscellaneous. And one real big problem seems to be the filing of 1099 miscellaneous as in other than a 1099-S, because a 1099 miscellaneous is for services provided. And would be treated as ordinary income. So if the IRS was looking at a misfiled 1099, should have been filed as a 1099-S, not a 1099 miscellaneous, and you treated it as a capital gain, you'd probably get, you may get some sort of correspondence from the IRS saying there seems to be a problem here. So if you're selling timber, make sure that whoever's buying the timber from you provides you with a 1099-S for the sale of the standing timber. You may receive a additional 1099s if in fact you're paying them or there's some relationship to the ordinary income component of a sale. I can't help but mention what the IRS loves to see is people keeping good records. I can't stress enough that the IRS is looking for you to tell them what you have. Does it have to be perfect? No. Does it have to be accurate to 6 decimal places? No. But whenever you make a choice or somebody makes some choice for you in regards to keeping your timber tax records, you really should jot it down, create some sort of journal so that you can explain yourself if in fact an examination ever occurs. You know, what's really important here, I've said it already, but you know, the sale of a long-term capital gain, the net capital gain may be taxed at 0, but generally no more than 15%. Otherwise, you owned it for over a year, and it is a capital gain designated asset, as opposed to ordinary income, which, you know, could be all over the board. And in some cases, your tax rate is a combination of both of those. There's a capital gains worksheet associated with filing a 1040 where the process is determined what part of your overall tax rate is long-term capital gain and what part is ordinary income. Here's a real critical, I lose about 1/3 of my potential clients because of this. And that is some exclusion provisions, or effectively the tax rates for long-term capital gains. I've copied this out of an IRS publication, but the 2 lowest tax rates, which represent in the case of a single taxpayer, up to $40,000 in adjusted gross income, and married filing jointly, $80,000. If you look in this column, this is really important. See that 0% tax rate? If you're a single taxpayer and your adjusted gross income, including the capital gain income, is $40,000 or less, you pay no tax on the net capital gain. And correspondingly, if it's a joint return, it's a 0% tax rate up to $80,000 in adjusted gross income. It's important to remember that, let's just say you make $100,000. The ratio of this limitation to your income, in this case, 80,000 over 100,000, 80% of the capital gain would be taxed at 0. So there's currently some really significant benefit, and many times this particular provision precludes any effort to spend a lot of time determining cost basis or even claiming any cost basis. As a matter of fact, if you are going to be reporting a capital gain and you meet these criteria, you don't have to claim any cost basis because you're not going to pay any tax on the capital gain, whether it's the gross or the net capital gain. So this is really, really significant, along with that 1099 provision I talked about earlier. Again, stop me if there's any questions relating to this, but I can't stress how important this is. Generally speaking, if you use TurboTax or some sort of tax service, you don't even know this. it automatically takes a look, and you only see what your actual tax is on the last line of your return. So when we're looking at timber, stumpage is the sale of standing timber. It's also what within the IRS is called a 631B sale, which provides this unique benefit for the sale of standing timber. And it, as a practical matter and realistically, there should be some benefit. Most people don't sell timber a year and a day after they buy it. Sometimes it's a very long-term investment, and it's pretty hard to say that sale of standing timber doesn't deserve, some sort of preferential tax treatment. Sale of cut timber, is if it's already cut, it's no longer a capital asset. Generally speaking, if it's a business, there may be a capital gain portion and an ordinary portion, but I'm going to get into how that scenario affects some of us. As I said earlier, property taxes, I'm not sure why I have this slide where it's located, but you can deduct it annually as a Schedule A itemized deduction, or it can be capitalized and deducted as a portion of the timber sale. All right.
Hey, Jim,
Yes.
is this a good time? Is this a good place to just take a couple minute break for anybody who
Yeah,
needs to?
certainly would.
You want to, this is a great chance for people to jump in as well. Any questions out there?
Absolutely.
Well, Jim, you're going to be hanging out there during our, we'll probably have a.
Well, I'm going to take about 30 seconds.
I hear somebody. Go ahead.
And
Okay,
I was
go ahead.
struggling to unmute myself. This is Ian Smith again.
Sure.
So this is going backwards a little bit. I did get a conservation grant from the NRCS, and they did issue me a 1099. So, if I was, basically, using that money to make improvements to the forestry stand, am I right in thinking that I take that money as income, but then I deduct the amount I spend, implementing the conservation measures that they're encouraging? Because it's a cost sharing grant. They only pay about half of what it costs to do
Right.
the measures.
So it depends on what you're actually doing with it. Remember, as I said earlier, if you're an investor, like a lot of us, and you get money for something that is not deductible as a business expense, if you report the income, you can capitalize that into the cost of whatever asset you're creating or improving. Or you may have an opportunity to actually exclude some or all of that from income, so long as you don't double dip and try to capitalize or expense it. I think that perhaps maybe for the benefit of the overall presentation, that perhaps we can have a separate conversation, hopefully somewhat brief, and certainly at no cost to you, with some more details on that, if that's okay with you. But
That's fine with me. I don't want to slow this down.
yeah, I have in past years got bogged down with trying to deal with examples. There's, it's a very unusual circumstance to be able to exclude payment like that from income. So I certainly would more than happy to give you a hand, and I wish this was all simpler. During my entire career and since, I've tried to talk somebody into making that process either exclude it all or just make some sort of simplified process, because the one that's in section 126 doesn't make a lot of sense. They just don't want people to get some sort of windfall from these kinds of payments. And I'm not sure it really works that way. So
Sounds good. So
I'll
Ian,
make sure you have my contact information.
I will make sure you two have each other's, or Ian, you have Jim's contact information.
Okay, that'd be great.
So I need about 30 seconds to a minute.
Sure.
And I will return.
Okay, I will mute you and we'll all meet back. Let's call it 6:08. We'll all come back.
Many people have tried to mute me and few have succeeded. So
Well, I'm going to try.
okay.
Okay, we'll see everybody at 6:08, 6:05 now. All right, Jim, now you got to figure out how to unmute yourself. There you go.
I'm unmuted.
All right. So we're back on our timber tax workshops, part 2. And again, well, anybody who's got questions, jump in, but barring that, Jim, you're back.
Okay, now we're really into the meat of what I believe most people are interested in, and that is, how to allocate your cost basis and reporting the gain from this sale of timber. As you can see up here, there's an IRS form, an information report, known as a Form T, as in timber.
Right in the pot, and that's warmed up. Maybe
I think somebody's not muted, but getting some background. Anyway, the Form T, to me, is a record, an excellent record-keeping device. In addition, as you'll see, an instrument that really helps in determining what you're going to report for a gain. Most tax professionals aren't familiar with it. Remember that tax preparers generally don't have a wide following, a wide activity with timber sales. It's not required, but it's a great document to support whatever you, it's not required to actually be filed with your return, but if you were asked to support what you claimed, it's a particularly valuable tool, especially where it's an IRS form. It's not a typical tax return type form. Now, as you can see here, I described a medium capital gain estimate. I probably should have been a little more creative, but I'm going to now stop sharing my PowerPoint and share with you what I would call a fairly typical capital gain estimation. So bear with me. Okay. As you can see, it's a Form T for timber. I've created a working Excel spreadsheet to do this process. The IRS does not do that. The IRS has only PDF form, fillable forms. They don't want to be involved in actually calculating the kinds of information that is necessary to complete this. This is a multi-part document. And what I'm going to go through here, as I said, is a fairly typical situation. It's the allocation of a 2015 inheritance for a 2018 return. This was one of my clients, and it just served to be a good one, and I continue to use it. And because this particular taxpayer secured the services of Sappy Forestry, in particular Paul Larrabee. Some of you might be familiar with him. I have permission to use his name. Obviously, it's good advertising. I think he's now on his own, but he provided, as part of the service of making buying the timber from this taxpayer, they provided an overall timber inventory, and they provided it, in saw timber, log type properties, both hardwood and softwood, and in pulp categories, which would be not just pulp, but perhaps biomass, some sort of chips. And because the sale was in 2018, they inherited it in 2015. So I got this inventory and I grew it back to 2015. And then I used Maine Forest Service. Actually, I used prices that Paul Larrabee had going rates for 2015. Normally, I would use Maine Forest Service prices, and I'll talk to that. So the point was I had to determine the fair market value of timber that was acquired by inheritance in 2015, the fair market value. And that's multiplying this volume times this price to get this value. And we chose to deplete this, recover costs, in two categories, in pulp and saw timber. Many times, and you may see it you'll see it in another example, I combine those so that we might get an overall price per ton rather than a price per 1,000 board feet or per ton. If a lot of sales were going to occur in this category of saw timber in the short term, it's probably advantageous from a cost recovery standpoint to treat the depletion in this fashion. This really isn't as difficult as it looks, especially if the seller had some assistance from a professional in this case. And as I said down here, any future sales, any future depletion needs to recognize that timber grows, say between 2 and 4% per year. And that's going to affect the process, and you will see it. So here's how I allocated this. There were 86 acres involved. This was because I had this valuation, and it was a woodlot. There were not a lot of, see, I grabbed this valuation up. If you look at my spreadsheet, it said go to cell F19 and place it here. And it had also said go to D19 to get this number of board feet, 1,000 board feet, and then multiply them and get that. And same with pulp. So once I've established those, I simply did a subtraction. In this case, I went back to an allocation piece, but that allocation was a result, and I'll show you when we get to it, of getting the timber value and deciding that the balance was the land value. That can work. One of the examples I'll show you shows that it doesn't always work, but it worked in this case. And so once I had that, this is the actual timber sale that occurred. The products, how much was sold, and what they got for it. So they made a $35,000 timber sale, and they received a 1099-S, in this case from SAPI. So I had that available to me to work with in terms of depletion and so forth. So what I need to put this down here. I converted this, combined these categories of sales over here into a common unit. You know, I sold 156,000 board feet and 313 tons. So those numbers are going to be transferred later on into the depletion schedule and into the determination of a profit or loss. So I'm going to move this back. So then we go to the actual Form T, okay? Form T, facsimile. This is not the IRS form, it's Jim Norris's version of it. It looks identical, but I made a disclaimer that it's not their form. You have to, and so you can identify where it is, what it's located, how you acquired it, and the year you acquired it. And I kept reminding that it was inheritance so that people, anyone looking at it would know that. Well, as it turns out, the fair market value of this property, as determined below in this example, you can see I put the word residual here. I mentioned it earlier, but this number is a result of coming up with a timber value and subtracting it from the overall fair market value. And notice I have legal expenses associated with the fair market value of that property. So that the actual total was $80,000. And that $1,000 is effectively going to be prorated based on the timber versus land value. So this establishes the cost basis. It, you know, we generated this. It's kind of nice, easy in the future on this one because we're not going to have to redo it, as I'll show you. So that's how we allocated the cost basis, 187,000 board feet and 186 per 1,000 board feet and $3 a ton is what you're going to be able to deduct for every 1,000 board feet you sell and every ton you sell, $3.14. So as you can see, another part of my overall worksheet is a sheet called depletion. This is pretty straightforward. It's what we have for starting quantity and cost basis. And these, I went right back to the acquisition here. See that 230? That's 230 right there. So it's using a spreadsheet like this makes it a lot simpler and avoids, you know, generally math errors. And same with the cost basis and this was for logs and this was generally for pulp. Now, these are our starting balances. The wood grew for 3 years at 2%. So there was 14 MBF grew during that period. So it has to be added to the original basis. And that's where we come up with this 244. Nothing changed in terms of cost basis. So these are essentially the balances for that year before you claim depletion. You divide this by this, you get this. Notice it's a little different than what we had back on the acquisition sheet. And the reason is this right here, timber grew. There's more timber, 244 versus 230. So it diminished this number. we cut 156,000 feet. So we multiply that by the depletion unit, and this becomes the cost basis that we're going to deduct when we determine the profit and loss. And I did the same thing with pulp. Okay, so the final part of the Form T, meaningful part, is the profit and loss, part 3. We data the sale. I pointed out where we got this sales information. I linked the original allocation way back on the allocation sheet. See the 35,208? That was from this timber sale right here. So I just grabbed it from when I was in this spreadsheet. And because it was just a timber sale, we didn't sell any land. If you recall, I pointed out what we're going to be able to deduct. So I just picked it off the depletion schedule, 27,597. And the same with pulp. So we had a sales price, we had our cost basis, plus we had direct sale expenses. In this particular case, this is how much they paid Paul Larrabee for overseeing and a commission for this. The net capital gain, as you can see, is only at $1,400. And the big reason for that is this was only a 3-year period, okay? If this had been a 20-year period, I'm sure that the cost basis in relationship to the sales price would have been far more different. So, in a nutshell, this was a fairly typical stumpage sale. And if people want to ask a few questions now regarding the concept here, they're welcome to do so.
Yeah. Yep, anybody who's got a question, jump in here.
I went pretty fast, but this historically has been fairly typical. This record, as you'll see later on in my next example, you can just continue this. We had a 2018 sale, but I can create an extension of this spreadsheet for 2021 and just carry over the depletion numbers. The ending balances here become the beginning balances for the next sale. So anyway, I guess there isn't any, so I'm going.
Oh, wait, jump in.
Okay.
I was waiting for a moment of silence.
Yeah, there you go.
So going back to the capital gains, where you said the effective tax rate for a married couple would be 0 if the capital gain was less than or equal to $80,000. Does that mean in this particular instance, if they sold, 35,000, would they not be paying any capital gains anyway?
Well, as I said, it's not the $80,000 doesn't apply to the amount of capital gain. It applies to the adjusted gross income of the joint return. So let's just say that you made $100,000 and it included $35,000 timber sale. Okay, so what it's saying is that roughly 65%, which is I'm sorry, 135,000 80,000 over 135,000, whatever that fraction is, say 60%. 60% of this capital gain will be taxed at 0. If in fact the adjusted gross income, including this 35,000, was less than 80,000, the tax rate on this number, right, 1,400 would be 0.
Okay.
So, you know, if that's the case, you know, I would advise my client not to claim necessarily to claim any cost basis because their overall income put them into a category of not having to pay anything there, no matter what that number is.
So you'd leave the basis for a later time.
Well, yeah, I mean, especially if, you know, you plan on doing some additional harvest, because generally speaking, as you claim cost basis, okay, depending on the type of sale, your depletion unit is going to get smaller. So claiming the actual cost, it's you know, it's $28,000, $29,000 you won't have against, you know, subsequent sales. For a lot of people who aren't making regular sales, it becomes a moot point. But the important pieces here is remember that this is a direct cost of making the sale, and it's used as an offset, as well as the cost basis being an offset to the sale. Okay?
Who else has a question?
All right.
And then I also just say that this is a lot of information. So if it turns out that after the presentation's over and you've slept on it and you have some questions, emailing us will definitely be would be certainly something you could do. This is an ongoing conversation.
This is being recorded, so you do have an opportunity to slow down, stop the recording and take a peek and so forth. So I'm going to go to another example. It's one that I just finished 2 days ago. I sanitized it, and I have.
Oh, Jim, I'm going to interrupt you. I think Mike McGuire, were you about to jump in there?
Yeah,
ahead.
Jim. So I'm a consulting forester, and you know, one of the things that often happens, as you probably know, during the course of dealing with the client regarding a timber harvest is that there's often like, oh, could you also have the logger cut that, make me a nice view, and they end up doing some service work that really doesn't have much timber value per se, and so I struggle to know how best to how that's handled from a timber tax point of view, because sometimes I might help the client negotiate different stumpage prices as a result of what they're asking the logger to do for a service. And I'm just trying to figure out if you have any advice, how best.
See no evil, hear no evil. That's a great question, in the sense that, as you said, many times, not only the kind of work you described, but road building costs, the added cost that the logging contractor incurs, whether it's gravel or whatever, many times is blended into the actual sales price. It, depending on what's advantageous, that if it's blended into the sales price, it's near impossible, for the IRS actually to determine that, unless by doing that, the sales price becomes less, the sales price per unit becomes less than the original cost. If it were like this particular, this transaction was only 3 years, there could have been that situation you talked about where extensive work was done and the price that was paid was actually lower than the price that was determined to be their cost basis per unit. Losses tend to be a red flag for examinations. But I do think that you need to remember that on a scale of 1 to 10, looking at the amount of cost basis claimed on a timber sale is about a 3. First of all, because they don't understand it. But, this is what the IRS calls a timing adjustment. We know in this particular case that the total cost basis in timber is $43,000 plus $9,000, period. And if you use it all too soon, that's it. Subsequent sale may not have any. So that's why this cost basis is fixed. It's not like taking a credit or claiming an exemption that you don't deserve. And so there's a diminishing return for the IRS to be worried about you accelerating this. So I would suggest that I wouldn't lose a ton of sleep over that. Losses, historically, way back when I was first involved, there was didn't seem to be any such thing as a loss on a timber sale. We just assumed that stumpage prices always increased at a, small but consistent rate. But as we have learned, when I was able to secure Maine Forest Service historic stumpage prices back to the 50s, there were lots of periods, and we see it now, where stumpage prices increased, stumpage prices decreased. And depending on when you got in the market, when you decided to get in and when you decided to sell, you could actually have losses, just the way you do with, stock sales, for instance. So historic stumpage prices from the Maine Forest Service are particularly helpful. And in recent years, I'm hesitant or slightly nervous about doing it, but I've reported a number of losses. And the only reason it was really a loss, the landowner didn't know how much he paid for the timber. But in doing an appropriate allocation, he jumped into the market just before it, bought the property just before there was a big decrease and sold it, and it produces a loss. And over the long run, you know, is probably not going to be a loss. But as technology and markets change, we're seeing, you know, that's a real possibility. So I guess we really shouldn't be quite as fearful about showing a loss. Businesses who show a loss year after year after year draw attention from the IRS, trust me.
Yeah, well, especially with the current market with, you know, for, or lack thereof rather, for, you know, like softwood pulp and biomass,
right.
it's becoming an increasing reality that there's just not much value there. And when you have high grading on top of it, that's
Yep.
ubiquitous throughout the landscape, you know, there's just not a lot of value there. But still, those you know, poor quality trees are blocking someone's view, for example, and they want some work done, and the value is just not there in the timber to bring in that logger and justify a profit.
Yep. Well, you know, the only rule is there is no rule, really. I mean, we see all sorts of variations off that, the type of sale and, you know, what landowner objectives are. I'm going to move on a little. I'm looking at the time. I've got 20 minutes. Is that okay with you, Mike?
Absolutely. Thank you very much.
Okay, I'm going to share another another file, and that's the one that I just okay. All right, this one is something that I just finished a few days ago, and this is actually a sale that the landowner happens to own now 900 acres. And they made a sale. They hired a company to oversee the sale of forest products to a couple mills, several mills. Inherent in that was a sale, effective sale of standing timber, but also sale of cut products to a mill. Those generate different kinds of tax treatment. I'm not going into quite as much detail because I have one more example I want to use, but I just wanted to point out that in looking at this, the timber sale at the mill was far more substantial than the net that was received by the taxpayer. This $46,000 represented a price, technically a price they received for the sale at the mill, and that was net of the sales price at the mill, and I'll show some of that, cutting and hauling. And the actual price they received was for the capital gain would be determined from, you know, some stumpage prices, and the two technically should be similar, but they're probably differ because there was some benefit to organizing the sale in that fashion. So that kind of described the sale. And we seem to be seeing more and more of that. I'm freezing up a little here. I'm going to stop sharing this and share it again to see if I can There we go. Not quite sure why. I'm having some, there we go. All right. This was an inventory. This happened to be an AFM, American Forest Management inventory that was done for the landowner. And this represented logs and pulp, all in, fortunately, in per ton values. And I would point out, if you, once this was combined, this was actually a purchase in 2020 and a sale. So they're not going to get capital gains treatment, but I went through the process for them. The value of the standing timber, the retail value, was $720,000. Remember, this is a 900-acre parcel. Now, my taxpayer had no idea what the retail value was. And if he did, he had no intention of paying $720,000 for that timber. And this is a point I kind of want to make. In a sale like this, you can't liquidate all this timber, okay? And so any knowledgeable buyer, if they look at it, there was an appraisal done for this property. It valued the property at about $600,000. The landowner paid $475,000. So he, in effect, recognized that he couldn't pay $720,000 for this because he couldn't recover that $720,000 immediately. And that works in reality too for real. This is essentially a real timberland property. It's 900 acres. It does have some, some other assets involved, as you'll see. So what I had to do was come up with the fair market value of this property. Now, if you can see here, I have 540,000. But that 540,000 represents, if you look up here, the retail timber value reduced by 25%. I don't know whether it should have been. I just felt that I needed to recognize that they couldn't liquidate this. This isn't always the case. As you saw earlier, we made no effort in doing this. It had 20 acres of shoreline, 52 acres of barren, and 900 acres of actual timberland, almost 1,000 acres. And so I came up with my per unit costs. I tried to estimate this 4,000 for the shore represents a large portion of the shore. Only part of it was really usable. So these in timberland, $100 an acre, and the barren 50. Is it perfect? No, but at least I've stated what it is. Based on my experience, it'll work. I came up with a fair market value of $700,000 for the property. That was contrasted with the appraisal of $600,000. So he paid $475,000. So he paid roughly 2/3 of what I consider to be the fair market value. So what I did was I applied 67% to each of my fair market value components so that I would come up with $475,000, which is what he paid. And that modified all of this by 1/3. And I bring this example up only because I just noticed the mistake and I'm going to correct it. I said 40 down here. I don't know. I felt a fair way of doing that was 25%. It would have, if I had done differently, I would have had to have adjusted all these fair market values by 45%. And it would suggest that I didn't know what I was doing here. This is not an exact science. It's another reason that I guess some people secure my services, because I may have some sense of, you know, what the IRS will accept for judgment calls. And I've never had the IRS challenge anything I've done, because this is not Greek, but, you know, difficult. This process is this sophisticated because it was a substantial purchase. So then I create this same acquisition sheet, 475, and I get the allocations again. I go right back and pick them off here, and due to rounding and so forth, I got 476 here, and if I was a little more careful, I could get that, but this is clearly going to be acceptable. Depletion wise, I had everything was converted to tons. So we had the saw logs and the pulpwood were combined. And this cost basis was picked right off the acquisition. The tonnage was, we went through the same process and came up with $8.18 a ton. That represents an average of both saw log material and pulp material. They sold 2,000 tons, so they're going to receive a $17,000 in cost basis. And we're going to use that in the profit and loss. And subtracting the amount cut and the cost basis, these are the ending balances. One thing that I did here is I created a subsequent year, and I had a timber sale and I had a depletion, and these starting balances for the subsequent year were the ending balances in the prior year. So that's how this working with a spreadsheet works pretty well. So the profit and loss is pretty interesting, because we don't have just capital gain income, we have ordinary income as well. Their ordinary income was 46,000. Because it occurred in the same year, you can see these are pretty close. When I looked at the capital gain, I picked that right off the timber sale, that 39,000, right here. This was when I computed a hypothetical sale of the standing timber. So anyway, when in determining the capital gain, I started at that point. I reduced it by 17,000, which we saw was the cost basis. What's very unusual here is the cost direct sale expenses. The reason that 20,000 is so high is he paid $4,000 for a consultant forester. He paid, in order to get to the area they were cutting, he had to repair a bridge. And also there was road construction. The roads were very long, and it was separated by a highway. So I took 50% of the road construction costs. In a subsequent year, this number is going to be a lot lower, but for the year in question, it was that high. And he had two different log contractors, so that's where that came from. So that $20,000 really knocked this down. As it turns out, this was not a qualifying sale, but I've explained to his accountant why I've got it here, and he's not going to claim a capital gain, but normally that's how that would happen. So in determining the ordinary gain, which was, it's a fairly simple process, and that is, this was the gross proceeds minus the hypothetical sale of standing timber to get the amount that was deductible, as reported as an ordinary gain. And that's how this process would work. If this had been over a year, it wouldn't have been a problem. So then I went for him and just created a hypothetical the following year with depletion, a hypothetical sale. All he's got to do is fill in the blanks here. And the same with a profit and loss. Notice the second time the sale, the actual proceeds are still pretty high, but they're only half of what occurred before. So that's what I was trying to point out. My point in all of this is that you could have just capital gains and you could have capital and ordinary gains. One of the things he's going to get when he gets a 1099, he's going to get a 1099 for, in excess of $100,000. But he's also, what's going to happen is that the costs of cutting and hauling and commissions are going to be deductible by his accountant against that. I'm going to kind of rush here a little because I want to show you very quickly one other possibility, and that is what I call a simplified sale. And what I've done here, the sale was relatively small. The sale was by a landowner who didn't have any idea what his cost basis was. He did know, I looked at historic records, and I'm very comfortable. They made no timber sales in the interim. So I knew that he had cost basis in timber, but I really didn't know for sure how much. But, it was a 1985 purchase and a sale in 2018. And I took some liberties here in the sense that I didn't have any inventory. We didn't have a lot of detail. So I simply made a relationship between 1985 and 2018. And you can see here, that was 75%. So I knew what they sold timber for. And I knew that that was in 2018 prices. I knew that 1985, the relationship of prices was 74%. So I just simply said that 75% of this number would be their cost basis. That is a gross, it's quite a simplification. And then I adjusted that because of growth. And I just simply said that his cost basis was $1,200. There was a forester cost involved and his capital gain was $1,300. Now, that I've simplified that real quick because we're running out of time, but I've done that a number of times, but all this data right here, if anybody questioned it, I could say, if you don't like it, tell me what I need to do. But I did not have good information from the landowner. And it was a small sale. He hadn't made any sales. I was certain that he had cost basis. I provided another fact sheet with him. I saved them a lot of money paying me. We couldn't justify going out and getting an inventory. So anyway, we used historic information from Maine Forest Service, neutral party. So those are three types of transactions that could occur with varying degrees of, detail. And, that was how it, effectively had to be. And I'm comfortable that the IRS will accept the judgment calls that I had to make there. Ta-da.
Ta-da.
Boy, I'm getting hoarse. I think a glass of red wine is in order.
So I'm going to go ahead and thank you, Jim, and I'm going to end our recording. And then just to make this a nice, neat 2-hour program. And then if anybody who wants, is it okay? Anybody has questions, you stick around and answer those questions. But I want to thank everyone who did attend.
Actually, I noticed somebody asked for my email address. It's Jim Norris, lowercase, 1650 @gmail.com.
And I also send everybody an email letting them know that the recording is posted. It will be probably Thursday, and I'll include your email address.
And may regret this, but my phone number.
I can add that too if you want to the
Okay,
email.
go ahead.
So I'll do that.
And, I'll deal with you as best I can. I'm not going to be around next week, but I will be around after that. There's no golfing, fishing, or hunting for a little while. So I should be available to help you either casually or professionally. So I hope this worked out for you. I know it's a lot of information. It's not something you see every day. So anyway.
Well, thank you, Jim, for doing this again. We did it in February and we're doing this in March. And I know that I get the impression that, this is like moving sand as far as tax laws and, what people should be thinking about when they're doing this harvest. So it's nice to have someone with some real experience in this.
Remember that the world is not hanging in the balance here. I won't say the IRS is your friend, but they're really not your enemy. And with dealing with capital gain on the sale of timber, It's not one of their highest priorities, and I think you're treated accordingly. So good luck, and like I said, you're welcome to get in touch with me, as I said, casually or professionally.
Terrific.
Okay?
Great.
I think I hear some clapping.